Ira, could you just talk about what people have wrong when they talk about the concentration of commercial real estate on regional banks and this being a really significant concern?
I think everyone tends to look at a commercial real estate loan and assume it's the exact same type of loan, the same type of borrower, same type of structure, et cetera. Reality is every single commercial real estate loan has some different nuances associated with it, whether it's an office loan, whether it's a multifamily loan, whether it's a single purpose loan for an owner-occupied individual looking to just support what his or her doing for their individual businesses. The geography makes a significant difference as well. The size of the loan makes a big difference. You know, at Valley, our average office is only $6 million in size, which is a very small type of loan. Really, it's just a doctor in an office in New York City. That's it, which is very different from what you see in other portfolios.
Even still, there is a sort of fear that we haven't seen the real repricing in real estate, given the stasis that we've seen in the market. How much have you had to reprice assumptions of your holdings at a time where mortgage rates have skyrocketed and you see a real lack of demand, particularly in urban areas?
I think it's a really great question because there's a bunch of different variables that run into a repricing scenario. One is just sort of where the interest rates are, where cap rates are. The other is behavior, right? So what's happening from a behavior perspective? Are people putting back into the office? You know, are people changing behaviors as to what size offices that they want? Those are harder things to sort of determine when you're looking at the repricing risk. For Valley, we've had $2.8 billion of loans repriced in the last 12 months or mature. We have not had to restructure one loan at that whole $2.8 billion. Other portfolios across some of our peers have had to restructure those loans based on interest rates, based on behavior changes. So once again, it goes to the uniqueness of each individual organization, how they underwrote, the type of borrowers that they have. But every commercial real estate loan is not the same.
Good morning, good to see you. And again, we sit in this Bloomberg room and we talk about commercial real estate and we talk about the pressure that it can be brought to bear on the real economy. So put it in context. You know, you're lending. What have you brought the credit committee together and said? Have you changed the credit rules? Have you tightened things up? Have you given the credit team a new definitive line, which is tighter, smarter, let's pull back? What is the message that you've given to the credit committee?
Look, I think credit across the entire space has definitely pulled back, right? And I think that's some of the things we're looking at. I think the stress test that we do, historically, we run 200-300 basis points of stress tests. So today's interest rate environment's 5-6% on wherever rate that we're doing. We're now saying, hey, instead of just testing 200 basis points up, now we're testing 300 basis points up. You know, at Valley, I think we were always concerned about what happened with the actual cap rates, right? We had cap rates get down to 3%, which is crazy. We floored ours at 5%, which I think makes a different type of borrower that we were looking at. So I think we're trying to be more granular in what we're looking at.